Thanks for joining us here at the Pinnacle Institute, live on YouTube. My name is Steve Moses, and we are going to talk. So this session today is a little more for people who've got some experience with options and who've traded some options. I've done many YouTube sessions for Pinnacle over the last couple of years. We've done sessions on, basically, what's a call, what's a put, what's an option, what really is the right when you buy an option and the obligation when you sell options. We've talked about options as insurance. We've talked about how you can profit with options when stocks don't move. You can sell time, not intrinsic value. We've talked about a lot of things. Today, though, I've heard, from the sessions that I do at Pinnacle, and I've been trading and or teaching options for almost 19 years now. But a lot of, options are not the easiest asset class to learn. And for those of you on the webinar today, means you've got some experience and you understand, stock is easy. In the sense, look, trading is not easy. But if you're trading stock, if you're trading futures, if you're trading Forex, those are directional trades. Whether you're using a support line, a demand zone, if you buy a stock, goes up, you make money, goes down, you lose money. Pretty simple. And when you buy a stock, there's only one stock to buy. If you were trading Goldman Sachs stock and you were waiting, and let's say the support line or the demand zone was at $200 a share. You put an order to buy the stock at 200. If it hits 200, you buy the shares. If it doesn't, you don't get filled. Pretty simple. You put your stop loss, your profit target, your entry stop and target, and it's pretty simple. Trading futures, trading Forex, same thing. Shorting stock. If the stock has a resistance line or a supply zone at 250 and it hits 250, boom, in order to short the stock. It's simple in that sense. There's only one stock, Goldman Sachs, and I'm just using Goldman Sachs as an example. There's only one stock, Goldman Sachs. You're either buying it because you think it's going up, shorting it because you think it's going down. That's it. Options have a lot more moving parts. If you're bullish with an option trade, or if you're bullish on a stock and you're looking to profit off of that stock's potential up move with options, you might have 8 or 9 or 10 different bullish strategies at demand. While there's only one stock, there are potentially dozens of strategies to profit off of that stock's move. Okay, so I hope that makes sense. So what we're going to talk about today is in the money options versus out of the money options. And in the money options have what we call intrinsic value, and out of the money options have absolutely no intrinsic value, but they have time value. And that's actually what makes options different from every other asset class. And you'll see this in a few minutes when I do the math to show you what we're talking about. So if you want to trade options on Goldman Sachs, even if you want to, hello Brazil, welcome. Even if you want to trade a call option instead of Goldman Sachs stock, you have dozens of strike prices to choose from. You may have dozens of expiration dates for that option to choose from, because that's the thing that makes options different from every other asset class. Stocks don't expire. Don't get me wrong, a company can go out of business. The stock can, Bear Stearns or Lehman Brothers, a stock can go out of business, but that's not what we're talking about. You could own a stock for 50 years. Your great-great-great-grandparents could have bought shares of GE, General Electric, passed them down, profit or loss notwithstanding, you still own those shares, or your family could still own those shares. But if we're trading an option today, it has an expiration date. It may be today. Today's Friday. There are options that expire today. There are options that expire next Friday, 2 weeks, 3 weeks, 4 weeks. You can buy options on the SPX index that expire in like 4 years. You can buy options on the ETF, the SPY, that tracks the S&P 500 that expire in 2.5 years. They actually, on the SPY and on the SPX, they have options that expire every day. When I started trading options almost 20 years ago, they were just 12 expiration dates a year, 12 monthly expiration dates, and that was it. Now there are weekly options, daily options. They've extended the expiration date. So my point is, there's a lot more choices. If you're bullish on Goldman Sachs and you're looking for an option trade, you have a ton of choices, both on when the option will expire and which strike price you want to trade. And we're going to talk about in the money versus out of the money in just a couple of minutes. And I'm going to do a comparison between buying the stock versus buying an option, and then buying in the money options versus at the money options, or what we call out of the money options, and what makes them in, at, or out of the money. And if anybody has any questions, please put them in the chat box, and I will do my best to answer them for you. All right. So again, if you are really brand spanking new with options, this might be a little confusing. So please keep your questions to what we're talking about today. If you've got any issues, some more basic questions on options, we'll give you my email address. You could come to the Pinnacle website, or you can email me. I'll put out my email address at the end of the session, and we can help you there. I'll be teaching an options class at Pinnacle in a couple of weeks, and I do webinars there 3 or 4 times every week on using options to trade for short-term income, long-term gain, for protection, for everything that we talked about. All right. Okay. So buying options. Okay. If you want to buy the stock, and we're going to talk about call options today. So a call option is like a supermarket coupon. It gives you the right to buy an asset at a set price until an expiration date, usually on sale. Okay. So, the example I always teach with is if you have a $3.99 bag of Doritos, but you have a 99-cent coupon at the supermarket, well, no matter what the price is on the bag of Doritos, if you've got a coupon that hasn't expired, you can buy the Doritos for 99 cents instead of paying $3.99 for the bag. Okay. So a call option is like that supermarket coupon. So instead of buying Doritos, let's say you wanted to buy Goldman Sachs stock. You could go out and buy the Doritos, or you could go out and buy Goldman Sachs stock. Now, the problem is Goldman Sachs stock is a lot more than $3.99. Okay. In the example I'm going to use here, it's $240 a share, $225 a share. Today, it's trading at $333. Okay. So it's a lot more expensive. But what if you thought Goldman Sachs stock was going to go up? So you could buy the stock. Okay. Or you could buy the coupon, the call option, giving you the right to buy the stock. Now, remember, the coupon example I gave you, you have a 99-cent coupon, Doritos are $3.99. What if you get to the store and that bag of Doritos has a $10.99 price tag? All right, for $10.99, those better be some magic Doritos. But no matter what the price is on the bag, no matter how high they raise the price on the Doritos, you still get to buy the Doritos for 99 cents because you have a coupon that hasn't expired. Well, what if we bought a call option giving us the right to buy Goldman Sachs at today's price, no matter how high the stock goes in the future? It's just like the coupon. Okay. So, but the difference is there's only one bag of Doritos and only one coupon. In the stock market, while there's only one stock, there are multiple coupons or multiple call options at different, what we call different strike prices. And some of those coupons, some of those strike prices are in the money, some are at the money, and some are out of the money. And I will explain as we go forward. So, buying options in the money versus out of the money. So let's take a look at the stock. And I just mentioned Goldman Sachs. Okay. So in this example, Goldman Sachs was trading at $226.26 a share. Okay. Now, we're not talking supply or demand yet. That's just the price of the stock. And if you wanted to buy 100 shares of Goldman Sachs, it would cost you $22,626. Now, obviously, you don't have to buy 100 shares of stock. You could buy 50 or 10 or even one. The reason I'm using 100 is options are contracts that when you buy options, you're buying the right to buy shares in the future or sell shares. And when you sell options, you're taking on the obligation to buy or sell shares. And an option contract either gives you the right or assigns you an obligation to buy or sell 100 shares of stock. Okay? So for comparison purposes, we're going to look at 100 shares of stock, one option contract versus 100 shares of stock, because the one contract gives you the right or the obligation to buy or sell 100 shares of stock. So Goldman Sachs trading 226.26. If you were going to buy 100 shares of Goldman Sachs stock, that would cost you $22,626. Now, that's a lot or a little depending on your account. None of my business. Okay. Now, let's say, for argument's sake, the stock is sitting at demand or support, or for whatever reason, actually, you think the stock is going up and you want to buy the shares today. Now, hopefully, as a trader, short or long term, as a trader or an investor, you have a profit target. You know, most traders, one of the biggest mistakes novice traders make is they don't have a trading plan. They buy a stock and they say, well, I'm going to sell it when I make money. Well, okay, what if it doesn't work out? You know, the markets are all down this year. I mean, I know the markets are up today, but basically the Dow Jones is the best performing index year to date. It's only down around 11 points. The S&P, the RUT, the NASDAQ, the RUT and the NASDAQ are down, 12 to 17%. And it was a lot worse about a month ago, but stocks don't always go up. So people will say, well, I'm going to buy a stock and I'm going to sell it when I make some money. And then the stock starts going down and starts going down. Well, how do you know, when are you wrong? When are you going to sell it? You know, Netflix was trading at 700 last November. It was at 190 a few weeks ago. It's still only at 225 or so, give or take, today. So who bought Netflix at 700 and probably still owns it today? Because they don't have a stop loss. So as a trader, you want to have an entry, a stop, and a target. And you want to take profit if it gets to your profit target. You know, in my humble opinion, the only thing that sucks more than a losing trade is a winning trade we let become a losing trade. What if you bought Goldman Sachs at 226 and it had a resistance line or a supply zone at 240 and you didn't take profit because you got greedy? I call this the Ralph Kramden syndrome. If you watch The Honeymooners back in the day, what is Ralph's famous line? To the moon, Alice. So what if you bought the stock at 226? The stock got to 240 and you're up 14 bucks a share and you're going, ooh, I think it's going to keep going. I think it's going to keep going. I'm not going to take my profit where I said I was going to take the profit. And then all of a sudden the stock started dropping and dropping. You started giving back your profit and then the stock goes below 226. Now you've given back your profit and are starting to take a loss. So hopefully as traders, and we talk about this at the Pinnacle Institute all the time, entry, stop, and target, and having a trading or investing plan. Take small losses when you're wrong and larger gains when you're right. But know when to take the profits and know where you're wrong and when to take your loss. Okay, so let's say you bought Goldman Sachs stock at 226.26 and you said, I have a profit target of 240. Stock gets to 240, supply, I'm going to sell. Okay, stock goes up. All right, it gets to 240. Now, here's the thing. When you buy stock at 226.26, think about your answer. Do you really care when it gets to 240? See, stocks don't have an expiration date. So you could buy look, you could have bought Netflix at 700. It's down at 225, and you could own it for 10 more years until it gets back to 700, if it gets back to 700. Obviously, I have no idea if Netflix will ever get back to 700. Okay. Matter of fact, the stock Crocs, C-R-O-X, those lovely plastic shoes, in 2007, they missed earnings by a penny. Stock was trading at 75 bucks a share. A year later, it was trading at 79 cents a share in 2008. By 2021, it got back to 75 bucks a share. It took 14 years to get back to 75. So sometimes stocks do come back and you can hold them forever. Okay? But we took our profit. You bought a stock at 226, you sold it at 240, you made a profit of $13.74 a share, or $1,374 on your 100 shares, and you got a 6% rate of return. Woohoo! Anybody have a problem with that trade? Nope. I mean, the only problem might be it cost you $22,600 to buy the 100 shares to make the $1,374. But okay, hey, 6% rate of return. Until a couple of months ago when interest rates were zero, if you could get a 6% rate of return, that was huge. I mean, where else were you going to get, those kinds of returns with your money? So nice trade. Okay. Obviously, not every trade works out. So let's just use a 10% stop loss. Okay. Now, by the way, if you got stopped out, you don't have if you were using a 10% stop loss, you don't have the appropriate reward to risk here. Okay. You're risking 2,200 to make 1,300. One of the things we spend a lot of time on at Pinnacle is a reward to risk ratio, 3-to-1. If you're hoping to make almost $1,400, you should only be willing to risk about $450 or $500, give or take. Okay. But that's a separate conversation, a trading conversation. But there's your profit. You're going to buy 100 shares of Goldman Sachs at 226.26. Sell it if it gets to 240. Okay. Now we're going to talk about options. We're not buying stock. Stocks are expensive. Now we're going to, when the stock is at 226, and let's just say it's at the demand zone, it's at the support line. So when the stock is at 226.26, we're going to buy to open a long call position. And we're going to sell to close the call when the stock gets to 240. Just like you're going to buy the stock, buy to open the stock, BTO, buy to open the stock at 226.26, sell to close the stock when the stock gets to 240. Okay. Options are derivative of stock. You only want to be in a bullish options trade if you are bullish on the underlying asset. That should make sense. And if you are and your profit target would be in the same place on the stock, and your stop loss would be in the same place on the stock. If the stock broke below the demand zone, below the support line, you're going to get stopped out for a loss. Okay. Well, if you buy a call option, that's a bullish trade. If the stock closes below the distal line of the demand zone, why do you want to stay in a bullish trade if you are no longer bullish on the stock? Answer, you don't. Okay. So when the stock is at 226.26, we're going to buy to open a call. Buy one of those coupons. Okay. And we're going to sell to close that coupon for a profit if the stock gets to 240. So in the money, call option, a 210 call option. Now, why is a 210 call option in the money? Because it has what we call intrinsic value. I'll explain that in a second. Now, remember, I told you options are sold in contracts, and each contract would give you the right to buy 100 shares of stock. So if you were going to buy a May 210 call option for $18.65 times 100 for 100 shares, if you exercise the option, it would cost you $1,865. Now, right off the bat, some of you are realizing, wow, I could buy Goldman Sachs stock for $22,600, or I could buy a coupon or a call option giving me the right to buy Goldman Sachs stock for only $1,865. Wow. Now, this option at 210, first of all, it expires in May. Now, it's July now. When I put this together, it was a few months before May. Don't worry about it. May is in the future for this example, okay? A May 210 call. We now have the right, just like you had the right to buy Doritos for 99 cents, no matter how high priced they price the bag, you have the right to buy Goldman Sachs stock at $210 a share, no matter how high it goes. And this is where people usually ask me, well, why do I have that right? Well, if Doritos are priced at $12 a bag, Why do you get to buy them for 99 cents? Because you have a coupon, which is technically a contract. I know nobody thinks of a supermarket coupon as a contract, but it is. If that coupon doesn't expire until tonight at midnight, that means any time until tonight at midnight, you can walk into the supermarket and buy that bag of Doritos for 99 cents, no matter what the price is on the bag. And if they don't have the Doritos, they got to give you a rain check because they are obligated. It's a contract. Okay. So we think Goldman Sachs is going up. If you're a stock buyer and you think the stock's going up, you buy the stock. Stock goes up, you make a profit. Stocks go down, you take a loss. Okay. We don't want to trade the stock. We're buying a coupon giving us the right to buy, a call option giving us the right to buy the stock at 210, no matter how high priced the stock goes. Okay, now, the intrinsic value, remember, our profit target, we said was 240. The supply zone, we said was 240. Now, intrinsic value, what does that mean? What does the coupon have to be worth? What does the call option have to be worth? Well, when you buy a call option, you're buying the right to buy the stock at that price. So if we're buying a $210 call option and the stock is at 240, if we exercise the option, we bought the stock at 210, and then we sold the stock at the now current price of 240, well, if you buy a stock at 210, sell it for 240, you're getting 30 bucks back. Regardless of what you paid, the option is worth $30. Does that make sense? Well, now to figure out your profit, you have to subtract your cost. So we bought a 210 call option, expiring in the future in May. Okay? Okay. For $18.65. By the way, that's the most we could lose on this trade. You buy stock for $22,000 and the stock tanks, you could lose tens of thousands of dollars. But if we buy a call option for $1,865, no matter how much the stock goes down, the stock could go to zero, and you are only risking $1,865. Now, the stock gets to 240 if the stock, obviously we don't know if the stock is going to get to 240 when we enter the trade, but for our purposes here, the trade was successful. The stock gets to 240. We sell our call option at expiration for 30 bucks minimum. Subtract our cost of $18.65. We made a profit of $11.35 a share, or $1,135 on the contract. Now, by the way, if you really liked that stock trade where you made 1,300 bucks and you got a 6% rate of return, but you had to spend $22,000, here we made only $1,135, but we only had to spend $1,865. We got a 61% rate of return for 90% less risk. That's one of the huge benefits of trading options when you're right versus stock when you're right. And I'll do that comparison with the numbers in a few minutes. Okay. Now that's called an in the money option. Okay. And it has a delta of 0.88. Delta is something that we use to figure out how much the option premium changes based on the movement of the underlying stock. Don't worry about it for now. All right. Now, that option is in the money because when the stock was at 226, a 210 call had $16 of intrinsic value. And then we paid a little more for the time value until the May expiration. Okay? All right. So there's your in the money option. It's below the stock price. Now let's look at an at the money option. So the stock's at 226.26. We're going to buy a call option, a coupon with a different strike price. So over here, we have the right to buy the stock at 210. Now we're buying the right to buy the stock at a higher price at 225. Okay, well, gee, we're buying the stock at a higher price, has less intrinsic value. We're going to pay less for the option. Now, right off the bat, a lot of people go, $18.65 for the right to buy the stock or $7.60 for the right to buy the stock. If you don't understand options, and that's the purpose and the focus of today's session, if you don't understand options and how they work and how they move, and you just think, gee, I'm going to buy, you buy a call option, stock goes up, you make money. Well, then, gee, I'm going to buy the cheapest option. And this is why a lot of retail traders, a lot of rookie options traders buy options. The stock does what they thought it was going to do, and they still lose money. If you buy a stock and it goes up, commissions notwithstanding, you can't lose money. You made money intrinsically, but you can buy call options. The stock can go up and you can still lose money. And I will show you that in just a second. All right. Now that option for $7.60 would cost you $760. All right. Well, remember, the target for the trade is 240. We're still buying a call option because we think Goldman Sachs is going up. But now look at the intrinsic value. If the stock is at 240, but we have the right to buy the stock at 225, well, the intrinsic value is not $30 anymore. It's not the difference between 210 and 240. It's the difference between 225 and 240. So it only has $15 of intrinsic value. But we also only paid $7.60 for it. So we made a profit of $7.40 or $740 per contract. Now, some people are thinking, well, okay, we made less money. Why would somebody buy an at-the-money option? Here's why. Look at that rate of return. Holy moly. Now, look, Americans, we're number one. We're number one. How would you like to be at a party, Labor Day party next month, and you're sitting there talking to people saying, yeah, I was in a trade on Goldman Sachs, an options trade. I got a 100%, 97%, but I got an almost 100% rate of return. That sounds really sexy, doesn't it? I mean, the only way you get a 100% rate of return on a stock is if the stock doubles. How many stocks double? Okay, well, the last few years some have, but okay, still, stock has to double to get a 100% rate of return. In this case, the stock only had to go from 226 to 240 to almost virtually double your options investment. But here's the thing, boys and girls. We don't pay our bills with rate of return. We pay our bills with profit. And while that 97% rate of return sounds sexy and sounds cool, you made almost $400 less than the guy who bought the in-the-money option. You know what they say? It costs money to make money. Yes, we made money here. But if you spent a little more money, now some of you think you spent a lot more money because you spent $1,100 more, but you made 50% more. Let that sink in for a second. So there's your at-the-money option, and then which has a delta of around 0.52. Now let's look at the out of the money options, because this is what will bite you in the butt if you don't understand how option prices are figured and how options, which are derivatives of stock, move in relation to the price movement of the stock. So when the stock is at 226, just remember, we're buying a coupon, we're buying a call option, giving us the right to buy the stock at 210 or 225 or now 240, no matter how high the stock goes. Okay, and if the stock goes up, you're thinking, well, I'll make a profit. So far, that's the case. If you bought either of these strike prices or any strike price in between 210 or 225, you're going to make a profit. Okay, well, wait a second. If I think the stock's going to 240, why don't I buy a 240 call option? And hell, that's only going to cost me $1.80 or $180. Well, here's why. Now, look, there's a difference. I'm sure most of you would agree, whether you're buying a car, a watch, a camera, there's a difference between cheap and value. You can buy something cheap that's not a very good value. And something can be what you think might be expensive, but could actually be a good value. Well, here's an option for $1.80, $180. It is obviously the cheapest option by a lot. And compared to this May option, it's 90% cheaper. However, If the stock gets to 240 by expiration, and you have the right to buy the stock at 240, remember, you exercise the option, you buy the stock at 240, the stock is now at 240, you sell the stock at 240, what do you get? What's the option worth? Zero. The intrinsic value is zero. What's your profit? Zero. What did you lose? 100% of a very cheap option. Look at these three numbers here for just a second. The May 210 call in the money had intrinsic value, cost you $1,800, but you made the most profit if the stock gets to the profit target. The cheaper you go, the less profit you actually made. And if you bought the out of the money options, the stock actually went up from 226 to 240. And this is what messes rookie traders, retail options traders, messes them up. Well, I don't know. I read Options for Dummies. I watched a video. I saw somebody on Twitter. I followed somebody on Twitter. Okay. I bought a 240 call option. It was really cheap. Stock went up 14 points, and I not only lost money, I lost 100% of what I paid for. This game is rigged. You can't make money with options. I bought a call option, the stock went up. Yes, you can, because these guys bought call options and made money. The game wasn't rigged. You just bought the wrong option. Does that make sense, everybody? Okay. Now, obviously, we don't know if the stock is going to get to 240 when we enter the trade. Look, if I knew that Goldman Sachs, when it was at 226, if I knew Goldman Sachs was going to 240, would I be here talking to you? Or would I be backing up the truck somewhere? Okay. When we enter a trade, we have no idea if the trade is going to work out. That's why we want to take small losses when we're wrong and make larger gains when we're right. So we can actually have more losing trades than winning trades and not blow up the account and actually still make a profit. Okay. Now, I'm leaving these numbers up here for a second, because by the way, not only did we make more money with the in the money option, look at the break-even price. Look at where the stock, now remember, the stock's at 226.26. Look at where the stock has to get to by the expiration date in May to break even on the option. If you buy the in the money option, the stock only has to get to 228.65. Why? Because if you bought a stock at 210 and sold it at 228.65, you're going to get back $1,865 for 100 shares. There's your break even. Anything over 228 is profit. On the other hand, you bought a cheaper at the money option, your break even went up $4. Why? Because if the stock's at 232.60 and you have the right to buy it at 225, you get back 760. But the stock has to go up 4 points higher. And what about our out of the money lottery ticket? Look at the break even here. Now the break even is above resistance. What if the resistance line or the distal line of the supply zone was at 240? If the stock only gets to 240, this guy's losing 100%. And the stock has to break resistance and supply by $1.80 to even just break even on this trade. And again, you're a trader. If that's the supply zone or the resistance line, what do you feel is the probability of the stock going above that? You should never enter a trade, an option trade, where the break even is beyond where you think the stock is even going to go, because you are taking the probabilities of making a profit, let alone breaking even, and reducing them dramatically. Now, obviously, is it possible a stock blows through a supply zone? Of course. Anything can happen. But guys, looking at these three trades, not only, there's your break even, not only was the in the money option the most profitable trade, it didn't have the best rate of return, but we made the most money and the stock had to go up the least amount to make a profit. Anything above 228.65, you're making a profit. Matter of fact, if the stock got to 232.60, this guy is still breaking even, and this guy would have a profit of about $4 or $400. Because if the 210 call and the stock's at 232.60, that option's got to be worth 22.60. We only paid 18.65 for it. We've got a profit. This guy's breaking even, we're making money. And this guy is still taking a loss. And if the stock got to 241.80, add $1.80 profit to this. This guy's breaking even at 241.80, and this guy's up around $13. Now, I know what some of you are thinking. What if we bought two of these in the middle? What if we bought two at the money options? Now, if the stock gets to 240, we've got almost $1,500, which is more than the 1135. That's a true statement. However, your cost is no longer 760. Your cost is now almost $1,500. It's over $1,500. But you just doubled your risk as well as doubled your profit. And we don't know that the stock is going to get to 240. We only know in hindsight now for this example that it got to 240. So why do traders even buy those out of the money options? What do you think? It's a lottery ticket, baby. I'm going to buy a really, really cheap option. The stock's going to go through the roof, and it's going to be like a lottery ticket that I bought for $5, and it's worth $500 million. Much bigger profits, sexy rates of return. You get bragging rights on Facebook or Twitter or Instagram or the Labor Day picnic on your fantastic looking trade. However, as I just mentioned, what if 240 isn't just your target, but it's the profit target at a supply zone? What is the probability the stock will break above the supply zone? I got to say, not good. If it's a legitimate resistance area or supply zone, not good. That's why you don't buy stock at supply, because you don't think it's going up. You think that's where you should be shorting the stock, and it's going to go down. However, let's appease the out of the money option guy. Let's say the stock does shoot up and blows past the 240 resistance supply zone and closes at 250 on expiration day. Okay? Woohoo! That out of the money 240 call is going to start to look real good right about now, because now you have the right to buy a stock at 240. You only paid $1.80 and the stock's trading at 250. All right? Right? Sounds good. Let's do the math. Watch this. Stock's at 250. For argument's sake, it got there. The stock's at 250. We bought the out of the money 240 call option. Now what's it worth? Remember, at 240, the option was worth $0. But if the stock gets to 250, our option is worth $10 at expiration. It has $10 of intrinsic value. And now we subtract only $1.80. What's our profit? $8.20. And if you thought a 97% rate of return was something to brag about, how about a 450% rate of return? Woohoo! That's sexy. You made $8.20 or $820 on your $180 investment, and you're strutting like, one of those guys. You just got $820 of profit and a 450% rate of return. But like I said, we don't pay our bills with rates of returns. We pay them with real dollars. So while a 450% rate of return sounds sexy and amazing, it is still only a profit of $820. And the stock had to rally 10 points above the supply zone. Is that possible? Well, of course it's possible. Hell, if the 69 Mets could win the World Series, I'm from New York. If the 69 Mets could win the World Series, anything is possible. Okay? However, probable? Well, it wasn't probable. Not many people were betting on that to happen. Now, Well, the out of the money option looks like the sexier, more profitable trade, at least in hindsight. It's not the most profitable trade, or even the trade with the highest probability of making a profit when we entered the trade. So let's compare, shall we? All right, let's start with the stock. $22,600 for 100 shares of stock. Okay? Okay. At 240, we said the profit was $1,374, a rate of return of 6%. There's nothing wrong with that, by the way. Some of you are stock traders. Some of you have large accounts. You might be trading self-directed IRAs. You want to buy 100 shares of stock. Okay, that's a beautiful trade. You made $1,374, got a 6% rate of return. Remember, our in-the-money option only cost us $1,865. We actually made a little less money, okay, $240 less, but we got, 1,000 times the rate of return. Okay, well, remember, at the money, less money, better rate of return, and out of the money, $820, and that's with the stock blowing past supply at 250 for a 450% rate of return. Now, let's talk about account size for a second. Now, again, I focus on dollars, not rates of return. Now, some of you are going to say, well, Steve, I don't have a big enough account to buy stock. I may not even have a big enough account to buy the in-the-money option. Okay, fair enough. So some people will buy at or out of the money options because that's all they can afford. Words of wisdom from Moses here. Don't buy the wrong option because that's the one you can afford. Don't enter the wrong trade because that's affordable. If you can't afford to place the right option trade, then look for another option trade. Just like don't buy stock you can't afford. I mean, you could use margin if you had some money, but I mean, okay. Now, I call this Stevie's 10% rule. What does that mean? For me, I would never put more than 10% of my account at risk in a trade. Now, obviously, if you put 10% of your account at risk in a stock trade, the stock would have to go to zero. Okay, stocks don't really go to zero. I mean, it happens a couple, once in a while, but stocks don't really go to zero. But by the way, stocks don't have to go to zero to ruin your year. Anybody, I mean, I could give you a list of stocks like Snap and Square and Roku and Zoom and Netflix and PayPal and Peloton, who are up 500% from the COVID lows and are back where they were trading 2 years ago. Okay, if you bought Netflix at 700 and it's trading at 225 today, you are not a happy camper. You didn't lose 100% of the stock, but you're down 80%. You can't even afford your Netflix subscription anymore. Okay, now you would need a $226,000 account to buy 100 shares of Goldman Sachs. However, to buy one call option, one coupon, giving you the right to not buy shares of Goldman Sachs, but giving you the right to buy 100 shares for $1,800, you only need an $18,650 account. Now, most people don't have $225,000 trading accounts, but I bet you a lot of people have $20,000 trading accounts. And I'm not, judging anybody. I mean, $20,000 is not an insubstantial amount of money, but you might have easily $20,000 in a trading account. And for those of you who are trading self-directed IRAs, you could have multiple six figures in an IRA if you were trading it. So, but still, you only need an $18,600 account. So another benefit of options, by the way, is you can trade options in accounts where you couldn't even think about buying the stock. You could not even buy 100 shares of Goldman Sachs in this account. Yet you could buy one call option and still leave 90% of your account in cash. Okay? You're at the money option. Now you're starting to see why people buy at and out of the money options. I could do this trade on Goldman Sachs in a $7,600 account. And I could, Lord knows, I could trade the out of the money option in a sub $2,000 account, still risking only 10% of the account on one trade. Remember, guys, if you got an $1,800 account, now that doesn't mean you couldn't buy an in-the-money option on another stock for 180 bucks. That would be the right trade. But this, as I'm showing you, is the wrong trade, but it's affordable. Don't make the wrong trade because that's the one you can afford. And this profit was only with the stock blowing past supply by almost 5%. It had a break resistance and break supply by 10 points, almost 5%. So there's my account size if you're following the 10% rule. Okay? All right. Now, to me, that's the best trade. Not the most profitable when you compare it against the stock, and not the best rate of return when you compare it against the other option trades. But all in all, to me, that's the best trade. Now, let's compare the stock versus the in-the-money call. All right? Profit. Okay, look, we know that. We made more money with the stock than the in-the-money call. However, look at the cost or the risk. So while the stock was a more profitable trade, remember, I talked about this in the beginning, even a 10% stop loss on your stock of 2260 would represent a much larger real dollar loss than losing even 100% of the options premium of 1865. And by the way, guys, when you're trading options, in 19 years, I have never taken max loss on an options trade. Let me repeat that. Have I had losing trades? Abso-freaking-lutely. Everybody does. But I've never taken max loss, because the only way you take max loss on an options trade is when you're wrong. If it's a bullish options trade and the stock breaks the demand zone and you're no longer bullish and you don't close the trade, if you're wrong and you stay wrong. Once you're wrong, you close the trade hopefully as soon as possible. I've never taken the maximum loss on an options trade because I have trading plans, entry, stop, and target. And when a trade goes against me, I systematically, unemotionally, as I'm sure hopefully many of you do, close the trade. The only way you would ever take max loss on an option trade is you're wrong and you stay wrong until expiration. I don't need to get off the Titanic. How low can it go? I don't mean to be glib, people died, but when the boat hit the iceberg, if you got off the boat within the first hour, you got on a lifeboat, okay, some people died, and you got pneumonia and you got hurt, but okay. But if you stayed on the boat, you went from wrong to really wrong, and an hour and a half later, you're at the bottom of the Atlantic. Stocks don't have to go to the bottom of the Atlantic, okay, to lose 100% of your option trade. Don't do that. When you're wrong, rip the Band-Aid off, take the loss, keep it a small loss, and live to fight another day. All right? Now, for an additional $239 of profit, look what your cost was, look what the size of the account was, and look what you had to risk if you were wrong. Now, let's talk about break even. I mentioned earlier, somebody said, what if we bought two of the at-the-money options? Okay? Yes, you'd have made more money. But remember, we're sitting here now in hindsight, knowing that the stock got to 240. But what if the stock didn't get to your profit target? Okay? We're looking at the prior profit and loss examples, believing the trade had reached 240. In hindsight, though, what if the stock only got to 230 and not to 240? Okay, let's take a look. Now remember, now we're not at 240, which was the original resistance line or the original supply zone. Now the stock is only at 230 and the options are expiring. Okay, well, let's go back to our May 210 call, which we paid $18.65 for. Well, the stock got to 230. Now that option has intrinsic value of 20 bucks. We paid $18.65. The stock missed the profit target by 10 points. We still made a profit, and we still got a better rate of return than the stock buyer in a smaller account. And we missed the profit target by 10 points. Okay, now let's look at our at-the-money guy. Okay, well, we got a 225 call. Stock only made it to 230. Uh-oh. That option only has intrinsic value of $5. The stock went up $3.75. We lost 260 or 34%. These are and remember, if you bought two of these, because you said if it hit 240 and we bought two of these, we'd have more profit. Yeah, that's hindsight talking. What if it doesn't get to 240, it only gets to 230? We just lost a third of our investment. And remember, at 230, forget 240. We still lost 100% at 240. At 230, obviously, it's still worth zero, and we lost 100% of the $180. The only way this out-of-the-money option makes sense is the same way a lottery ticket makes sense. Guys, by the way, how many of you would buy a lottery ticket for $100? Nobody. That's why lottery tickets are $1 or $2, because they're cheap and they're a dream. If these out-of-the-money options were, and there are a lot of reasons which we don't have time to get into today, there are a lot of reasons that the further you go out of the money, the option premiums get cheaper and cheaper and cheaper, because the probability is less and less the stock is going to get there. Okay? But you know what? You know what a lot of people think? How many of you buy lottery tickets? Right now, I think there's a Powerball lottery this week. It's almost $1 billion, I think, if I remember correctly. How many of you are saying, you know what the heck? For $2, I'll buy a ticket. For $20, I'll buy 10 tickets. Somebody's got to win, right? New York used to have the slogan, New York Lotto, you got to be in it to win it. Okay, fair enough. You know what some people think? For $180, I'll buy a contract. Goldman Sachs blows through the roof. 450% rate of return, baby. That's sexy. Yet, what is the probability of even breaking even on this trade above supply, let alone making a 450% rate of return above supply? And there's that key too, above supply. But remember, even at 230, this guy still made a profit. All right. Now, what's an even bigger retail mistake? You know what some people are thinking? If I don't know enough about options and I'm sitting there thinking, I could buy one of these for $18.65. This is only $1.80. Man, I could buy 10 of these for less than the cost of buying one of these. Now you're looking at a lot more than $180 loss. Now, what if the stock goes to 240 and you spent $1,800 and you just lost 100% of $1,800 because you bought 10 of them instead of one of these? Even if you had the $20,000 account, you should still have bought one of these versus 10 of these. Okay, and remember, if the stock gets to 250, this guy made $820. This guy still made more money, because if the stock gets to 250, this is now worth $40, and you've got about a $21 profit. You still made more money than this guy. 10 of these, wow. Okay. Thinking call options are created equally and not understanding the difference between in and out of the money options are really what separates the pros from the novices. And again, if we knew where stocks were going to go, guys, trading, look, if, it's July 20th. If I knew where the market was going to end, where the S&P was going to close on December 31st, I said it before, I wouldn't be here talking to you. Beep, beep, beep. That's me backing up the truck. If I knew where any stock was going to be even a week from now, on Monday, if I knew where Goldman Sachs was going to right now, if I knew where Goldman Sachs was going to close on Monday, I'd back up the truck. I'd either buy call options, I'd buy put options, I'd go long stock, short stock, I'd take out a home equity line if I knew where it was going to be. I don't care how good the probabilities are in any trade. That's not a guarantee. There are no guarantees in the stock market, okay? And there's only one guarantee in the options market. These options have expiration dates. I don't know where the stock's going to be on those expiration dates, but I can guarantee you that the calendar will move and those expiration dates will get here. But if you've liked anything you've seen today, options, there are options trades that have much better probabilities of making a profit. Let me ask you a question. When you buy a stock, what is the probability of making a profit when you buy a stock? Answer, 50-50. I understand if you're buying a stock at a support line or a demand zone, or if you think the earnings are good, blah, 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 blah. I get it. But mathematically, when you buy a stock, 50-50. No matter how many shares you buy a stock, it goes up a penny, down a penny, profit, loss. That's it, 50-50. There are option strategies that by design you can enter that can give you as high as 85, 90, sometimes 95% probability of making a profit. I'm not putting a dollar or a percentage on it, but you can enter trades that literally can give you an 85 to 90, 95% probability of making a profit. There are options trades where you can be wrong on the direction that the underlying asset is going to go, and you can still make a profit. Options are the only asset class where you can do that. There are options trades where you can make a profit if the stock doesn't move. Because remember, I told you the only guarantee is the calendar moving. There, you can sell out of the money. See, buying out of the money options makes no sense most times, but selling out of the money options, those are the trades where we can have 80, 90% probability, because we can sell options that have no intrinsic value. So you can't sell a stock that has no intrinsic value. If a stock is at 0, you can't sell it. If a stock is trading at 100, you can't buy it at 105 and you can't sell it at 95. But I just showed you we could buy in the money options, which means if you could buy in the money options and buy out of the money options, you can also sell out of the money options. And if we sell out of the money options that have no intrinsic value, even if the stock doesn't move, the calendar will move, and they will eventually expire worthless with no intrinsic value. Options are an amazing asset class. I think options are the greatest thing ever invented. Better than fire, better than the wheel, better than air conditioning. All right, not as good as single malt scotch, but I think options are pretty amazing. You have more ways to play a stock's move, or a stock's non-move, or a stock's direction using options. But if you are going to trade directionally, in the money versus at the money versus out of the money, there's your you have to see the numbers and you have to see the math. And obviously, guys, the in the money option would lose the most if the stock were really to tank. But of course, if you're buying at demand, you're buying at support, as soon as the trade breaks through the zone, you're closing that trade for a small loss anyway, or hopefully a small loss anyway. Does that make sense? All right. Okay. As you saw when you signed up, this was more of an advanced lesson on options here at the Pinnacle Institute. Check us out at pinnacleinstitute.com/upcoming events. If anything here today floated your boat, come check out our website. We've got a team of pros that, I tried to explain something today very simply. A lot of people think options are hard and complicated and confusing. I just think a lot of people teach them as hard and complicated and confusing. They're supermarket coupons. Once you do the math and you understand the simple concepts and you overlay options over your ability to understand market movements, institutional order flow, supply and demand, market turning points, trading gets a lot easier. No guarantees, never guarantees. And while options may not be the easiest asset class to learn, I think they're the easiest asset class to trade. Not because of a guaranteed profit, but think about it. If you can be wrong directionally and make a profit with an option, it's got to be there's got to be more moving parts and more fun stuff. Now, I also showed you today you can be right directionally with options and lose money. But once you learn supply and demand, market turning points, and then really learn the ins and outs of options, you really can put yourself in the